Good morning and welcome to Global Perspectives with Ned Group Investments. Today we will be joined by Steven Romick, Co-Portfolio Manager of the Ned Group Investments Global Flexible Fund. Steve will share his and the team's thoughts and ideas of what risk means when FPA manage their portfolios, about the ultra-low interest rate environment and their expectations for inflation going forward, and why they've had an ultra-low exposure to high-yield bonds relative to the history of the strategy going back to 1993. Let's take a listen to what Steve has to say.
Thank you for taking the time to listen today. Today's presentation will be guided by a number of topics that we've been asked to address. For those less familiar with Ned Group's Global Flexible Fund, I thought it might be helpful to offer at a high level some of its characteristics that differentiate it from most public funds. We manage the fund to achieve its goal of providing equity rates of return while avoiding permanent impairments of capital. We consider risk to be the chance we might lose money and not volatility, which is the institutional definition of risk. Because a company's share price moves up and down, sometimes a lot, does not make it inherently riskier. Episodic yet temporary price declines are just part of investing, and for us, represent opportunity to both buy and sell. The potential discomfort that comes with the ups and downs of the market must be borne if one is to achieve equity-like rates of return. Nevertheless, portfolio volatility has generally been less than the market as a byproduct of executing this strategy. The fund has capital invested in equities of various market caps around the globe, high yield and distressed credits or bonds, and more. We have more tools that we utilize than a typical mutual fund. However, we only use them when there is an attractive risk-reward opportunity. Just because you have a hammer, everything can't be a nail. As a result, at times our portfolio can look more plain vanilla, as is more the case today. Economic recovery and persistent, easy money continue to underpin the financial markets, allowing 2020's global stock market rally to continue in 2021 and benefiting certain positions held in the fund, as much as global stock volatility did temporarily hurt their stock prices in Q1 2020. I wanted to show this slide that depicts the almost 40-year decline in interest rates. I would argue that this downward trend to a zero cost of capital has been the single greatest driver of global stock market returns. Some analyses suggest as much as 40% of the market's returns over the last few decades have been due to lower interest rates. A lower discount rate increases the value of a future stream of cash flows, as well as pushes terminal values higher, which in turn drive equity prices higher. In addition, with bonds yielding so little, investors have put more risk in a quest for return, tilting their portfolios away from bonds and towards stocks. U.S. inflation is at a 4-decade high. No great surprise, given the low interest rates, huge increases in fiscal borrowing, and a generally easy money environment since the great financial crisis. That sets quite the stage for higher inflation. The pandemic has made things worse, impacting both size and availability of the labor pool and causing supply chain disruptions while durable goods consumption was rebounding. And add in the pressure of high energy prices. U.S. inflation was 7% in 2021. While this chart only depicts the U.S., the Eurozone recorded its highest inflation rate since the monetary union at 4.9%, while with German inflation at a 29-year high of 5.2%. Emerging markets have also had very sharp inflation increases, with some countries recording double-digit levels, while inflation has, however, generally remained low in the largest Asian economies. The expectations for future inflation are higher than recent history, as this chart points out. While one can reasonably argue that domestic inflation in the future could be lower than 2021, we believe that inflation will likely average higher in this next decade than the preceding one, something that is not currently expected. As you can see in this chart, with this inflation over the next 5 years expected to be less than 2.5%. Stocks around the world have historically high valuations, with U.S. companies leading the way. This chart that shows the U.S. and international stock market capitalizations as a percent of the size of local economies reflects that. The most expensive companies are driving much of these higher valuations, leaving many companies trading less expensively. The global flexible portfolio, on average, is of a higher quality than it has been historically, trades less expensively than both the US and the international market average, and has posted better earnings growth in the trailing 3 years. In addition, analyst consensus estimates has our portfolio companies growing faster than the average public company in the next 3 years. This chart shows that international stocks trade on average at a lower price earnings ratio than its US peers, using the MSCI ACWI ex-US and the S&P 500 for the respective international and domestic proxies. Since 2001, foreign stocks have traded at an average discount of 13% when compared to US stocks. Today, foreign stocks traded at an almost 33% discount, a 20-year low. We do not believe that the businesses we own outside the US are so substantively different in quality and growth prospects to justify such a wide discount, and thus our significant exposure to foreign domiciled companies. Wrestling with how much to own of stocks versus bonds doesn't seem like much of a contest today. The low starting yields of bonds in general, and corporate bonds more specifically, with their additional burden of potential default, offered a negative real yield at quarter end and into the beginning of 2022. With such an anemic starting point, it appears that the earnings growth potential of stock affords the better opportunity for those with a longer term view, despite higher than average equity valuations. The S&P 500's estimated PE for this current year of 2022 is 20.5 times, which in its inverse translates to an earnings yield of 4.7%. Given lower stock valuations outside the United States, the estimated 2022 earnings yield for the global MSCI ACWI is a higher 5.6%. Contrast this with a 1.5% 10-year US Treasury yield, or worse, the 0.07 and minus 0.09% yields for Japanese and German government bonds, respectively. Assuming positive economic growth over the next decade, we believe the total return potential of stocks should exceed that of bonds, albeit with greater volatility. And as I mentioned earlier, while volatility satisfies the institutional definition of risk, some ups and downs in a company's share price over the short term do not speak to what a business might be worth over the long term. It is not a truism that more invested equals more risk. There are different kinds of risk. For example, that being less invested in risk assets invites the greater risk of inflation eroding the value of your cash or conservative fixed income instruments. High yield bonds offer a gross yield of just 4.4% in the US and 2.8% in the EU. These paltry yields, though, are before some inevitable level of default. Using historic averages as a guide suggests that the net yields in the US might only be 2.5% and 0.2% in the EU, as shown in this table. High yield bonds have offered very poor yields in recent years, and we haven't had a distress cycle since the 2008-2009 downturn. The insignificant yields of the sector have kept us away. Just because we can invest in an asset class doesn't mean we should. If we had lowered our standards, though, and owned more high yield, the fund's performance would have benefited as the combination of lower rates and tighter spreads have increased corporate bond prices. The high yield market's good performance is in spite of increasing corporate leverage, declining average credit quality, and weaker covenants for the borrowers, which gives them the advantage versus the lenders. The US Federal Reserve and European central banks are doing their best to inhibit what should have been a historic opportunity to buy high yield debt. Low and negative interest rates take money away from savers and lenders and gives it to borrowers and investors, including speculators. When money costs almost nothing or even less than nothing, it perverts price discovery. Investors' thirst for yield, along with the Fed and ECB's purchase of high-yielding corporate bonds, have propped up prices at higher levels than they otherwise would be. If there is no cost of capital, then one can theoretically pay an infinite price for assets, which creates a backdrop for investors such as ourselves who insist on a margin of safety, a difficult backdrop, that is. Stepping away for a moment, stepping back, many managers start with an index benchmark when constructing their portfolio and then play a game of over or underweighting various names or sectors. In sharp contrast, we start with a completely blank page and have a portfolio that looks nothing like any index we've ever observed. So while we own many well-known companies that we believe are reasonably valued, we also round out our holdings with a collection of names that either remain starkly out of favor or largely absent from the major indices. Examples of such securities include our Asian holding companies such as LG Corp, Samsung C&T, SoftBank, and Swire Pacific, as well as the fund's Chinese-centric positions in Alibaba, Naspers, Prosus, and Baidu. We believe that many of these companies trade at discounts to our estimates of intrinsic values greater than 50%, based exclusively on the publicly traded marks, while also trading at single-digit multiples to our estimates of look-through after-tax earnings. As genuine long-term oriented investors, we relish the opportunity to pick up cheap or even free options, as we believe exists in the form of autonomous driving within Baidu or the cloud business within Alibaba. This is no different than how we viewed the asymmetric return optionality in past years in the form of Waymo/YouTube within Alphabet and Oculus or WhatsApp within Facebook. It's no great surprise that many of the fund's top contributors to performance over the last couple of years have been our technology investments that floated upwards on this rising tide. Despite taking some profits, we retain many of these positions. These companies share the common characteristics that they operate successful business models and traded valuations that, although not as expensive as they once were, we believe will still provide a reasonable return in the years to come. The financials in our portfolio underperformed as investors sold shares in a panic back in 2020, fearing that the economic downturn would cause such damage to loan and investment portfolios that there would be, in general, less demand for their products and services. The market was correct that their businesses would be harmed, but not to the degree that was ultimately priced into their stocks. There has been some recognition of this as financials have been strong performers in the last year and change. As a result, a number of financial positions have been reduced into this market strength. And I hope you enjoyed the presentation. And again, we appreciate all of your time. Thank you very much.
So for me, the key takeaways from Steve's presentation is that FPA don't view risk as being volatility, the more conventional metric used by institutional investors. Rather, they view risk as the possibility of losing money on a permanent basis. And the up and down price movements of companies in equity markets tell us very little about the future value or prospects of a company. Secondly, in spite of markets being at elevated levels, FPA view a much greater risk at present as that of high and persistent inflation eroding the value of one's real wealth over time. So given the flexibility of the mandate, they are able to take opportunities in global markets outside the US, where equity valuations are some 30% below those of comparable US companies at present. And finally, their ultra-low position to bonds has been due to the low starting yields and in corporate bonds in particular, the potential for additional default. So equity remains their preferred asset class for the long-term investor, albeit with the likelihood of greater volatility going forward. So with that, thank you all for dialing in. I hope you have found today's presentation insightful. If you have any further questions for the manager, please contact us through our Client Services Center or through your Ned Group Investments representative. Please would you take a moment to provide us with some feedback by scanning the QR code at the end of this presentation. Thank you very much and have a good day.